Money Miners. We're joined by two extremely insightful gentlemen in the world of commodity, China, macro, research, metals, all things property related. This is going to be an interesting conversation that we're having today, JD. We've got Bentley Attebery, who the previous guest of the podcast, a commodity trader who runs Mist Trading out of Singapore. Bentley's just a wealth of insight. He also happened to go work in a previous life with our other guest, who is Rogan of Rhodium Group. He's a China macro property analyst, and really keen to see the two of them kind of talk about the things that are matter in our metals markets at the moment, because there's a lot happening in the macro world, and I feel like commodity traders sort of have their finger on the pulse, and commodity traders like Bentley happen to rely a fair bit on the research that comes out of people like Rogan. So I think the two of them are kind of perfectly poised to unpack a lot of the things that matter at the moment. Thanks so much for joining us on Money in Mind, guys.
Yeah, happy to be here.
Yeah, cheers. Appreciate it. It's the third time on, third different continent coming from. So I guess from here forward, it's going to be, got to keep that up somehow. You
never know what's going to be, what time zone you're in, Bentley, or what background you're going to have, because you dial in from all sorts of places at all sorts of times. You're actually truly an enigma to me still, and I cherish it. I cherish the enigma that you are.
I think that's how commodity traders like to, I don't know, roam around, I guess. We get the wrong headlines.
we get the weird and the wonderful. And I remember last time we finished up with that long form conversation, Bentley, that we had. I felt like I really knew nothing before, and I actually knew something coming out of it. And you set the bar pretty high that time. I can see in the show notes you've put in some Chinese characters, so I'm expecting to learn quite a bit from you again. And I think China is the place we should start this conversation. Maybe with you, Rogan, given that is your area of expertise. What is the broader market and the consensus sort of thinking of China at the moment that you think is actually wrong?
Well, I think we're in a cyclical stabilisation within a structural slowdown. And so the credit cycle in China has gone on for far too long. The net interest margins are getting compressed, but there are some green shoots in the economy. There's certainly reasons to believe that some of these subsidy programs can lift growth marginally, the property market bottoming and potentially contributing to growth by the end of the year. Some of the investment side story may weaken, but ultimately China's going from 7-10% growth down to 2 to 3% real. But there's tremendous headwinds in terms of deflationary pressures and other issues related to the banking system, local government financing, revenues associated with value-added taxes and corporate income taxes. But ultimately, there's good reason to believe that this year will be stronger than last, and that we'll continue on this downward path of growth towards something in the order of 2 to 3%. But on the real estate side, it's not as gloomy as it looks. We had a long-term equilibrium of 500 to 750 million square meters. We're at 517 million square meters in March 2025. But that's down from 1.7 billion in March 2021, which was the peak. So it's quite the contraction. It's caused the economy to need to shift into new areas to find incremental ways to invest, domestic savings. And that's led to a lot of discussions around things, that are quoted as overcapacity or what's considered running ahead of domestic demand. And so there's areas where China's accelerating in technology and stunning the world in moments like DeepSeek. And then there's questions surrounding, how many more solar panels they need to produce when global demand is at a certain level. Let's call it 600 gigawatts per year. So, in terms of China, I'm relatively bullish in the short term, despite the headwinds we'll see from trade.
Bentley?
Yeah, so Rogan's going to have all the hard numbers like that. I'm more of a on the ground and physical, actual, transactions business, right? We don't necessarily, we use Rogan's research and that sort of thing, but I I guess from that perspective, I don't have it memorized, is what I'm saying. No, from that perspective, it's interesting with the property sector. Every time I come back here, I always like to just have a look around at construction. And really, I think the first time I was here was 2018, and don't have a great memory of, what it was like. Oh, there's cranes, right? They used to actually have, I guess, collect data on how many cranes are up in the major cities. And I don't know if they have long do that anymore, but just from the naked eye, last year it was really interesting because that would have been May of 2024 when I was here. And you noticed, especially in the major cities, that it didn't look like anything really changed. Everything was still being built. Even during the monsoon season, they were still, building, doing construction and whatnot. But you did start to see some areas of, let's call it like neighborhoods that weren't occupied. The best way to put it. I know we were talking before we had this conversation. Oh, there's like 30-story apartment buildings behind you, and you're a small town. That happens in a lot of like clustered little areas where people live, and there's a couple of those little clustered areas. So as Rogan said, it was over exaggerated. I think that's a good way to kind of state that qualitatively. Is you might have a cluster of 5 or 6 buildings that they're built, there's not really anybody in them, and that would be what people, I think, really kind of consider as like the ghost cities or whatever. So there's still a little bit of that around. But coming back this year, they finished building what needed to be built, and then now it's really difficult for them to get permits to build anything new unless they're a major developer, engineering, construction company, and they're in more of the tier 1, tier 2 cities. So they're being pretty strategic with what they allow to be built. And I think I mentioned it last year when I was on as well. Building and property, especially residential here, it's a different, the way it's done, the kind of the structure of how you build, buy, and own something is a lot different than what many people are used to in different parts of the world, let's call it. I don't know how it works in Australia, but I have a pretty rough idea. And here, though, when you buy a flat, right, you buy an empty concrete shell. So for a developer to build that building and just have a concrete shell, like no appliances, no wall, lights, nothing, right? It's actually pretty cheap. And then it makes it so their break-even costs are a lot lower, and then they're able to build more. And that is what it's part of the problems that led to everything, but it's also, it's all cheaper for people to just buy. So people own a lot of these units as well, even though they haven't developed them out. So if Rogan thinks the property market's bottomed, I do have a couple flats if he's looking to buy that I can sell for about half price. Only half joking on that, actually, but
so this is the real game too. Is there's a challenge in the tier 1 cities for upgrading. So the size of the real estate built a decade ago just isn't what people are looking for in these tier 1 cities, and so that upgrading demand, there's actually a shortage in some markets. So it's a bifurcated market where you have migration going to certain cities, talent going to certain cities, upgrading demand in those cities for nicer flats. But then you have this overhang from the fact that China has 300 plus cities with over 1 million people, and why were we building so many buildings in cities that didn't have the respective jobs associated with them, and what do they do with the overhang there in the developers? So the bad loans associated with it and solving that problem is long from over, but certainly there are green shoots in demand, and whether it's old housing needs to get knocked down to build new, better housing, or it's the size of the apartments that people are looking at. There's reasons to think that especially in these high income cities with stretched valuations, that you could still see new construction. So
exactly what you were that's a better way kind of what I was trying to qualitatively say. So a lot of these the neighborhoods where there's no one, are like mostly empty buildings. They're more in non tier 1 for sure, but even outside of like tier 2, tier 3, they're not. Once you even get into Huizhou, I think it's tier 2 or 2, 3, right? That you don't have that problem there in the middle of the city. Like Shenzhen, Guangzhou, they're still building. Like that's the demand there is just fine, right? I think that's what both of us are kind of getting at. It was interesting to see though, and I know speaking with Rogan a couple months ago, he brought up something about Shanghai, and I noticed at the end of last year, Shanghai prices went back above Shenzhen prices for the first time in 10 years. And I don't know if you were saying you had coworkers or colleagues that it just doesn't seem like the economy in Shanghai is slow at all, or it's hard to get a table, I think is what you said.
Yeah, so it's very funny because I'll analyze all of these cities' retail sales, and they'll generate into a book. And these tier one cities have had terrible retail sales numbers, but how do you quantify some of the services level demand associated with certain sectors? And so the retail sales continued to contract through March, but anecdotal stories I've heard, people are having a hard time getting a table at the nicest restaurants. So some of the bifurcated market, if I'm not buying a really expensive purse, I might be buying a nice dinner and moving to that services lifestyle that's more, reflective of what you see in Europe or the United States. But yeah, I mean, not to get too far into the consumer, but yeah, it is a strange market that can be cut in a million different ways to pull things out. But it all to say that there's reason to believe that the real estate market has bottomed. It doesn't necessarily mean that it will ever go back to what it was. It certainly won't. But a cyclical upturn from here isn't out of the question.
Rogan, if we try tie it into the Aussie market, what's your outlook for steel, and then going one step further for iron ore?
Yeah, so I mean, the bottom up estimates I've done for real estate related demand destruction are for copper. But on the iron ore side, I find a very compelling story that the upper bound is certainly going to be $100, and the lower bound could be as low as 60. The reasons being is that when China pivoted away from the real estate sector, there was a ton of money that went into a varying number of industrial industries, whether it's ethylene production, copper smelting, shipbuilding, EVs, solar modules, battery manufacturing plants, all of the cathode, anode material manufacturing. It was tremendous, and in many ways it's led to China leading the world and catching the rest of the world on their back foot as they look at these new emerging industries that are extremely power intensive. And so in that effort to pivot away from real estate and redirect investment into other areas, they created additional steel demand. But how many more factories do you need to build? How much more can, of the global shipbuilding quotas can you get when you're already at 60%? So if 60% of new ships are Chinese, it's, probably a couple million tons there. If you're talking about the exports of 7 million electric vehicles, it's a couple million tons there. And, add in the solar and the equipment and wind, it's a couple million tons. But ultimately, the embedded steel plus the steel product exports cannot continue to grow without getting tremendous reactions from, great trading partners for China. And so steel products falling into Vietnam and getting tariffed, or, import bans, it's South Korea, it's South Africa, it's Brazil, it's Mexico and Chile. These are countries that aren't necessarily aligned with the US on their strategic initiatives, but they're countries that have domestic capacity that's now dealing with Chinese exports that are extremely competitively priced, and so it's creating consternation. And so ultimately what it comes back to is, does the Chinese government choose to lower domestic production? And there's already evidence that they're going to move to do so. And so the headwind there is that steel production in China, steel demand in China is probably peaked. And so it's hard to see how the capacity is brought down, what quotas are issued at the provincial and local government level, how they respond to those in terms of, we're replacing old capacity with new, more carbon efficient capacity, but have you truly, ramped down that other factory? But yes, there are certainly big steel manufacturers that are cutting the hours of certain employees and reducing capacity to produce rod relative to flat products. The flat products can be used for cars and ships, and the rods are generally looked at in infrastructure and real estate. So that pivot has been ongoing, over 100 million metric tons in shift over the last couple of years. But ultimately, can they sustain the build out of more industrial capacity without contributing to deflationary pressures, which puts the economy in a much more difficult position? A deflationary debt spiral certainly is something China doesn't want.
That $60 number you mentioned for iron ore, that's quite alarming, I think, to a lot of people sitting here in Western Australia. To dive into that part of your response there, you mentioned before we started chatting the impact of Guinea and Simandou, obviously. What do you make of that? And, given your position in, sitting there in Washington, what is the broader kind of consensus view of the evolving landscape of the iron ore market?
Well, in the U.S., it's whether or not we should be more protectionist or not. I don't think they're necessarily looking upstream to where the iron ore is mined, or the price there where it's at. I do, and they're really concerned about these other critical minerals, but we come back to that. I think that the West African region, especially Guinea, is a very interesting story because of the bauxite production there and where it goes in terms of China's aluminum supply chain. The build out of this mine and the multiple sites, the railway, the quality of the ore, the cost of mining in a place that I lived in eastern Sierra Leone for a while. Once you're out into the bush, there are fewer rules. And so, the regulatory burdens and the like certainly are lower. There's political risks associated with the West African region, but, in terms of being competitive at the global scale, China was looking for a way to diversify supply chains away from Brazil and Australia. And this project certainly stands out as one that, increases supply when demand is about to decline.
Bentley, I have to imagine as well, you've done a bit of digging on bauxite. I know we spoke about the alley sort of chain, and just in the past couple of weeks, there's been some pretty noteworthy events. How close have you been sort of tapped into it lately?
Past couple weeks, not as much. I think late last year, we discussed it. I know I had whatever the 2025 predictions. Alumina as my what they're called. Well, that and zinc, I think. So I know what was going on there for the most part. There's a lot of this mistiming between new capacity of alumina coming online versus what's going on in bauxite and aluminium demand. So that was what really went on there. And once new production came online, Indonesia, India, and China as well, for alumina, you saw the prices come off quite a bit. Bauxite, haven't followed the markets too closely in the past 3 weeks, so I can't comment too much on that.
It was GAC's mine license was revoked by, I mean, it's been offline for
okay.
I think like 9-ish months, but the Ghanaian government has just revoked their mining license from the alleged refusal to build a smelter in country.
Oh, so I am a little familiar with that. There is, I won't say who. I know someone down there that's actually trying to get a project started, and they were required to do some downstream, like alumina, eventually at some point. I don't know if they need to do it before they can start exporting their bauxite, but he mentioned that was going to be a thing in Guinea, and they were going to do that. So I don't think it's necessarily a huge shock to people in that part of the industry, but maybe you guys got to ring up Aluminium Al to get the full scoop on that one.
Well, it's funny you mentioned that. We're dead keen to go to China with Aluminium Al one day. I reckon you should join us on that trip, Bentley, as an almost
that'd be amazing.
China local these days.
His story about I think it was from Jamalco when they had the bauxite, and they first shipment of that from, I guess, the Caribbean up to I think Qingdao or wherever it was, that the bulk port, and the moisture content, which is about right, like 18% is pretty high. They thought that'd be fine, and then it's just huge clouds of the red bauxite dust because
So they did it at night time. That was the
Forcing
best.
Exactly. Like that's China. Yeah, for sure.
Yeah.
Potential business risks, Trav. Potential business interruption. Business interruptions are not good. They are not good at all. Thank God there is a way to negate business interruption risk.
It sounds like you're a bit risk averse, JD, but it's important to mitigate this with insurance. In fact, CRE Insurance are the people that can help you mitigate business interruption with the best insurance broking capabilities I've ever seen that ever exist. When it comes to insuring mining projects or other construction and engineering projects, you want to work with specialised and experienced advisors, and God knows how many details could possibly slip through the cracks. This is not something you can risk when it comes to the health of your operation, JD.
Anything other than perfectly tailored will leave a gaping hole and leave you exposed. We've seen it time and time again, mate. A generic policy when it comes to insurance is no good. From mobile plants to contract works, liability to business interruptions, CRE have got you sorted. Insure it right, insure it the CRE way.
Mate, are you sitting on the fence? Give them a call.
Not after this.
Give them a call. Get your current policy looked at, because you know what, mate? It is a free review of your policy. It's on a platter. Can all but guarantee you'll be thankful that you did.
All but guaranteed.
Guaranteed. Yeah, I'll insure that risk for you.
There we go. Cool. CRE Insurance. Thank you, CRE.
Yeah.
Anyway, yeah, that's not fully in tuned with the gap story, but
Yeah.
familiar with what's happening. Yeah.
You spend a lot.
I think. I was just gonna say that, you know, the story I keep hearing from a lot of different parts of the industry is that everybody wants to localize, and every government wants, you know, Africa wants to value add onto things, and you know, every industrialized country wants to secure their supply chain. And so it just seems to me that we're going to have a whole bunch of ability to process this major metals, but you know, not necessarily demand at the end, or the supply of the raw materials.
It's the Indonesia model. So they've seen the success, right, from Indonesia, and for certain aspects, it's taken Indonesia a lot longer than maybe people think about. It's been, well, God, what, 20 years ish of them trying to do what they've been doing in terms of bringing the next stage of value add online in their country, and it's worked for things like nickel and tin, for example. You can't export tin concentrate from Indonesia. It has to be tin ingots. I don't know about, there's other, let's say, red tape parts of it that gets bottled up every once in a while as an annually. But you know, I think that's the model that other countries are trying to go after. And it's interesting when you talk about steel, because steel is such a simple one that everyone's kind of had for a while, and that's the one where it's just, I don't think you can slap the same sort of mindset on all these metals, because steel, it isn't that expensive to produce steel, and iron ore is fairly abundant as long as you have ports or have it in your country. And steel is a very domestic use in construction, right? So you got India, where they're gonna basically 3x their steel demand over the next decade. But as you guys, you know, are talking about, it kind of gets pulled from other places, and then they're not going to import Chinese steel. In fact, they're doing quite the opposite. But they still need the iron ore. And a lot of iron ore in India is not, especially with when they export. They don't really export, but they export low grade stuff, I think. So the whole dynamic of that, I think, too, when Rogan's getting that, is all right, you're going to have these more domestic supply chains, not necessarily the most efficient way of doing it. But for let's call it easier to produce commodities such as steel, it becomes, you kind of have to accept that at some point, you know, India will have overcapacity of steel. Are they going to start exporting, dumping the market? Sure. You'll have the same story over and over again.
The Indonesian example is a really interesting one, because capital certainly came into the country in response to their policy. There are a lot of tax holidays provided for investment in these industrial parks, like Morowali Industrial Park. And then like relatively recently, there's been a proposed regime change from the royalty front. Royalties kind of unfinished product going from sort of 10-ish% to up to 19%, just depending on nickel price. Surely that just kills that kills new investment, and when other countries try and roll out similar agendas of downstreaming, like, doesn't capital think twice before actually adhering, or do we need the metal so much from that specific country that there's no choice in some instances?
Ooh, I think it just depends on who's willing to take the risk. That's part of it, right? So we'll see what happens with Indonesia going forward. I think it'll be an interesting case study. How about that? Because there's a difference between doing something like that kind of tweak versus every once in a while just being like, no, we're gonna have 100% tariffs, or you're not allowed to export this, you're not allowed to do that. I think they've gained enough goodwill from the Fujianese or Chinese. It's a lot of Fujianese. They're very entrepreneurial part of China, and it's like 1.5–2% of Indonesians are what would be Fujianese Hokkien culture. And they make up, what you get? I think you guys said it. It was like something like 50% or 30% of GDP or output. It's kind of nuts, but
Massively.
So
massively.
I wouldn't expect, I wouldn't expect them to stop coming just for that. But at some point, I think it will erode it. Where's the line, right? Where you raise it a couple of percent, no one's gonna really care. I mean, they care, but it won't halt flows. You start going back and forth with major changes and a lot of uncertainty, and I think that's even worse. Can they bring that royalty back down? I don't. We'll see what the discussions come out of that. But I think a lot of times it's more of, if it's slow and steady, does a little better. If it's kind of all over the place, then that crushes uncertainty. But time will tell. And I know it's a different government, somewhat similar party, I believe, than it's been for the past decade plus. I don't remember how long was Jack gonna be there for? I can't remember, but it'll be interesting to watch that.
Yeah, I think a lot of, I mean, these major miners, making 30-year investments, if you're 15 years in and they come to you and everything's been hunky-dory for the last 15 years, and they say, hey, we want you to move upstream, and they say, well, what if we don't? And it's like, well, then you can't export your concentrate. You're in a challenging starting position in terms of the negotiation. So certainly the level of uncertainty associated with changing government policies is something that each company has to take into account. But you're in a challenging position when the mine is in a country and you don't have political power over the government in that regard. So it can be challenging, and I think Freeport's dealing with a similar issue in Indonesia now.
Yeah, great mine. I think it was one of my favorite mines to I guess dig into the engineering of it. But we'll talk about, I mean, there's a lot of uncertainty with that, but they were able to kind of work something out, I guess, getting concentrate out, because it's like, okay, well, the smelter isn't ready to come online, so all right, well, then let's allow another few 100,000 tons of concentrate shipments, which has helped balance the markets. I think the government has earned some goodwill in Indonesia for, it's a pain in the ass, but they've been a little bit reasonable with stuff like that. I don't know, reasonable, maybe not the right word. Flexible, I mean, like, okay, well, we're gonna ban it now, and then it still takes an extra couple of years. So I think at this point, if you're going into Indonesia, you know what you're getting into. But I think other countries need to, and governments, you can't go, I shouldn't say you can't, I don't want to offend people here, but you struggle when you go full Ghana, right? That's a different problem. Like,
you're going to say you can't go full Ghana.
Yeah, I mean, that's a whole mess. It's a real big mess. I think you guys are closer to that than I am, but we've had people poke us when stuff was going on there, and be like, we need to get you interested in X amount of gold. I'm like, I'm not a gold trader, but we're trying to get stuff out quick.
Rogan, let's go back to China. The evolution of the new energy market, to kind of clump it all together, has been astronomical. It's been crazy to view from the outside. What's your sort of take been on that? And maybe you can sort of hone in on EVs kind of specifically, and the emergence of hybrids in there too.
Sure. I'm happy to color this. End-to-end electrification is quite possibly one of the best stories coming out of China and the hardest to replicate internationally. And so, there's still consternation about what happened in Spain and Portugal over the last several weeks, but there are people who are saying that this is associated with a higher degree of renewable energy as a part of the energy mix, and the issues related to that. In China, over the last 12 months, the growth in energy demand has come from wind, solar, hydro, which had a drought in the previous period. So year on year, it looks positive. And then an expansion of nuclear. 3 months of contractions in coal. And so going into the second half of the year, there's a changing dynamic on the energy supply side. So the feed-in tariffs associated with renewables will be removed, which means that renewables will have to compete at market prices, in spot markets for demand. What does that mean? If everybody's producing solar energy at the exact same time, the spot market goes to zero. Then you have this, duck curve that you see in the Western world, and as a result, energy prices fall to zero, and there's essentially no money to be made in installing the next installation of solar. So future solar installations in the second half of the year and going forward will likely decline. What does that mean for something like batteries? In the short term, it means that there's a new avenue for storing energy and competing in spot markets at different times. There's incentives associated with installing batteries on your end of the grid, at your factory, and storing the energy for later use at cheap prices. So that end of the spectrum is going to change dramatically coming into the second half of the year, and that has material impacts on polysilicon, copper, aluminum, and we can, battery related materials, lithium in particular. But yeah, on the other side, you have this dramatic shift towards electrification. So, when I choose to charge my car, when I choose to charge my truck, I'm creating new demands that are also intermittent, that are also hard to calculate, and also can incentivize energy storage localization, because you can up the energy coming out of the battery relative to what's going into it. And so end to end, you need a stronger grid. And what we've seen in China over the last 12 to 18 months is that what was a cycle of growth in grid investment has broken out to a new level. And it's extraordinary to see, and it's hard to see anywhere in the world replicating what China's done there. In the last year or so, there's been a greater pickup of plug-in hybrids and hybrid electric vehicles relative to BEVs. But a lot of the demand in China has been driven at first by subsidies and consumer incentives, and now it's the price competitiveness of a lot of these vehicles, the convenience of being able to charge in some of these tier 1 cities, and China's ability to build out the grid at an accelerated rate. The number of charging piles, private level, we're talking over 8 million, public level over 3 million. Total charging kilowatt hours was 9.1 billion in September of 2024. This is an extremely hard thing to do from a grid standpoint, from an energy production standpoint. And so China, has moved in this direction. A lot of the energy that they're using to charge these vehicles would, some would say, is coming from coal and the like, and all of these supply chains are extremely energy intensive, synthetic graphite production and all the smelting of metals and the like. But yes, I don't want to sound too bullish on Chinese pivots towards renewables. I continue to think in the second half of the year we're going to see a return of coal as a major comeback. But what they've accomplished is stunning to me, and it's been wonderful to have the ability to watch it over the last 4 years.
Bentley, what's your sort of take of the implications of this on the metals that you kind of trade in? Maybe touching on some of those more niche and quirky metals.
Yeah, I think the one thing that I did definitely took off faster than a lot of people were expecting is the plug-in hybrid stuff. Look, you still can plug in your car to charge it, and really depends on, I guess, how much you care. Some people just plug it in whenever, even though you can just put petrol in it too, right? Where, you know, petrol price, gasoline prices here are pretty cheap, actually. Well, I guess these days they're kind of getting cheaper everywhere, right? It's sub 60 crude, but they're that expansion, I think, over pure EVs has been very interesting, and it's probably somewhat regionalized as well. Like around here, there's a lot of plug-in hybrids. People drive a little bit more, a little bit further than you would maybe in other cities. You still have like the cheap. I don't know. I was at breakfast this morning. You had the Hongguang Mini, Pokemon style with Pikachu. Happy girl at the steering wheel drive by, and I was like, that's funny. But it was also, that's the equivalent of what? Something around the lines of maybe 7,000 Aussies. So it's a pretty cheap alternative. And it's also a society that 20, 25 years ago, no one had cars. Very few people had cars. So what they've decided to do was, okay, we can't really compete with, I don't know, Volkswagen, BMW, Mercedes. You see a lot of German cars here. Can't really compete with them. So they did JVs, and they also then chose, okay, well, why don't we do our own style? They have a little bit different taste, right? It's a lot of luxury and tech they like in cars. And they went the EV route, 12, 13 years ago, when they really made that decision to put money into it, subsidize it. And that just took off.
Using JVs to enter a market and forge a competitive advantage. JD, this strategy sounds all too familiar, and you know who I'm talking about.
MMS, Mineral Mining Services, mate. Get MMS to your site right now. If you want to see what a turnkey mining solution looks like, call MMS. They'll tailor the job to a T for you, mate. They'll take the stress off your hands. They'll take the risk off your hands. MMS is the contractor you call if you want to sleep at night.
How good is this, mate? They've got 17,000 square meter operations hub to keep the fleet humming. A fleet of over 100 heavy vehicles and machinery and specialized bits of kit. They can rapidly mobilize, just say the word, that mobilize so fast, mate. And they've got the technical team to do the hard yards. Gold is still flying over $5,000 an ounce, if you can believe it, which means operations can make money right now. They can move the dirt to a mill, and you can make money off of it. It's all the ability to be able to do that is like never before. And MMS are the team to help you do it. You know why, mate? Because they have got the just get it done attitude.
They do. If you have a project in the too hard basket, you don't have the bandwidth, it's just lying on the side there, go search the gold price, look it up, realize what you can do. This is a win-win opportunity. Work with them. They'll work with you to unlock the upside. Just call MMS, the trusted mining contracting partner.
Now it's all their own brands, right? They don't see as many new vehicles that aren't Chinese. But what that's had on the lithium industry is you still see demand. Like, demand's been fine. It's more of a supply side situation, I think, in lithium at the moment. The battery energy storage stuff was an interesting thing that Rogan hit on there, where there was the policies that went in place where you no longer have to have energy storage systems with your solar, I guess, solar like grid, the solar farm. There we go. But realistically, you wouldn't do that, as Rogan pointed out, right? Because it wouldn't be economic without the battery storage, and that's made up for a lot of the deficiencies in demand from North America and Europe for EVs and lithium from that standpoint. But the supply side has been massive. I mean, you had South American brine, a lot more of that. It's a decent amount of that coming online, and starting to come more into China. I think Argentina exports are about double what they were a year ago. And that's, it still has to be re-refined. So just, I don't know how much people are familiar with that. That it gets re-refined into a battery grade material in China. So it still ends up here for the most part. I can go to Korea as well, not in the likes, but that has essentially flooded the market. And I was talking to I actually talked to YJ a little bit last night, and he mentioned that a lot of the refiners are in a position where they don't want to lose qualification with the downstream. So they're not turning offline. And that's why you see the supply response you have. We had a problem, not a problem, but situation last year where, spodumene was still in high demand despite prices coming down and, what you'd think of being oversupplied, like why is there such a demand for spod? But that a lot of that is just how the refiners are built and how they can make money. And late last year, when some production came offline, it was this, it caused a small spike in the market. What people did is they were able to go and hedge forward. So they pre-sold May and July, right? Prices in the spot markets are mostly linked to futures prices here in China. It's just a formula. So they were able to do that, and you've kind of started to see the impacts of that now, where that helped keep spodumene prices up in the 800s, where it was like, I wouldn't go out and buy a spot cargo, or we're going to win any of those SQM auctions when people were bidding 850, and I'm sitting there like, you can't make money on that. The only way you made money on it is if you pre-sold at 85, 90,000 RMB per ton, which $11,000-$12,000 a ton. So that started to actually finally wear off, and that's why you're seeing hard rock prices come down. Wilhelmina material we think has been coming to the market as well. Longer term demand wise, it's going to even itself out, where you have these pre pockets of demand that are brought forward that make up for levels of weaker areas, right? Where Rogan brings up the battery energy storage. I'll hit on that. So late last year, you saw a lot of these material flowing into North America, knowing that it was just going to be tariffed and never going to be profitable again. So North America has battery energy storage systems to be built out, and they have the material sitting there. But that's not going to come again. So this ebb and flow, and we're going through it right now, where that demand's a little soft, and same with EV. We saw Tesla orders at some point like near zero around in Asia. So yeah, we're right now, and you can see in the prices in lithium, that's where it's at. It's kind of pricing in what Rogan's talking about for later part of the year already, when you're looking at when people are making orders. So yeah, I guess
that's an interesting dynamic, right? You've got you're trying to disaggregate what's like genuine demand versus brought forward demand to kind of front run tariffs. That's
that's a huge thing. It happens cyclically, or I don't know, micro cyclically, whatever you want to call it, all the time. And there's seasonalities that then people pick up on, so you don't see that occur in price as much when it happens seasonally. But when it happens more for other non-reoccurring events, that's where it can kind of throw off the what you might see in production or downstream consumer numbers versus what you're seeing really happen at the micro level in the material sectors.
I think, one thing to break from the cyclical story here in terms of the lithium demand is that China over the last 2.5 years has pivoted away from the nickel cobalt based chemistries completely to the LFP. And so, when we look at that price spike, as China ramped up the production of batteries, and then you see nickel prices and cobalt prices going through the roof, you saw as the Chinese started building out their solar, it was polysilicon prices went through the roof. Lithium is the one that stands out as one of the most abundant resources on Earth. Whereas, nickel is concentrated in Indonesia and cobalt is concentrated in the DRC. And so, lithium, the abundance of it has made it just so challenging to navigate. I mean, are they moving to increase trading on the LME? Is this something you're seeing, Bentley, at all? Or like, are people just not, it's too hard to navigate in a public market?
Well, without like just ripping apart some of these exchanges, basically non-Chinese exchanges did the wrong way. So they try to approach it from, hey, let's make these average price contracts that are like an average price based on some pricing agency. And that doesn't work because you're not actually, as a physical player in the market, you're not actually hedging anything because that's not the market price, right? Where like LME metals, for example, that is the market. If I go hedge tin for, that's the actual tin market for it, right? Where it's a representation of average price of, some pricing agency, which who knows what really goes on there, and especially in smaller metals. So they kind of all did it wrong. Anyone that decided to do average price contracts, and for lack of a better term, from where I sit and as a commodity trader, they're pretty useless, and something gets way out of whack. Like basically, if I'm going to sit there and take advantage of some asset manager for whatever reason wants to buy 20% above the market 1 month from now, but yeah, okay, I love them for that reason. But where you had Guangzhou Exchange, they launched their lithium carbonate futures, and that's deliverable. Now, problems with it because the chemical, right? Reality is, it's a salt, but I hope I didn't say something really stupid there about it being a salt, but it is a chemical. It's not the most, the most commoditized material, and that creates some issues, and it's not perfect, but now everybody can base their contracts on that price because you can actually go forward and hedge it where there is a real market where, I can deliver on that, or I can go take delivery on it. There's, again, small things that occur there in terms of the material you deliver to exchange can't be more than, I think, 90 days old and stuff like that. But yeah, what I'm trying to get at is it just wasn't done right. There's an attempt at it. I know ABOX, which is like a Canadian company, they've been trying to launch something that's physically deliverable without setting up warehouses and that sort of thing. So until that happens, you won't see it as much as much physical use. So look, physical volumes, that drives market volumes, that makes a more efficient market. Look what happened to nickel. 2022 didn't work. It just blew out, right? The whole thing, that was a disaster. But what happened is they allowed more Chinese brands to be delivered in the LME. Well, that increased the physical volume that can flow through there. And look at it today. It's higher volumes than it was before, and the market is, let's say, functioning for the most part, right? So, that's the long answer, I guess, to the question of why isn't LME and stuff, and you got to have a physical contract for it to really be useful.
No, we talked about something, and I'm interested in this paradigm shift because it's important to copper demand. Is that when we spoke, lithium prices have dropped so much that, and the LFP battery prices have dropped so much that a lot of people that were talking about sodium ion batteries, number one, they're very low energy density, so it's not very, you're never going to put it in a pickup truck. But we talked about, you're saying maybe that the sodium prices have made it so that lithium based batteries are still in premise here that sodium based batteries don't require a copper film associated with them, but the lithium based ones do. So is there something there with the sodium based? Have you seen anything in the market, people talking about it more? I know that they're actually building batteries in China, but is it still, it's just a dominant lithium market?
Yeah, well, look, when we last spoke to somebody about it, March, I think it was BYD, right? They came out with like the hybrid LFP/sodium battery. I think that's like the greatest attempt at something really commercialized. It's still less than 1% of the market, and part of the problem is it's about double the price of LFP. So, and you would look at all the materials separately of the two, and you'd be like, oh, sodium ion can compete. The problem is that the entire supply chain, the entire value chain has been built around lithium and LFP, where kind of can't compete. You have to think about the size and scale of that. You would have to redo that with sodium. And there's other materials that go into it, like tin and stuff, that would, if you don't have copper foil and film anymore, which I didn't know. Thank you for letting me know that. But you still have other materials, and the logistics of building out an entire supply chain, I think, are something that maybe, unless there's a sustained period of really high lithium prices again, I think it'll kind of just sit in the background. It's the best way to put it.
Is it right to think, Bentley, that they greenlit that factory, BYD, when lithium prices were approaching $80,000? and there was,
Yeah.
much more
I mean,
impetus to do so.
I can't for sure say that, but that would logically make sense. There's always, technological studies that people do, and they want to, increase technology, find other ways to do things. And a lot of time, I will say, I spoke with a guy in the rare earths market about this, and he was bringing up that a lot of these R&D facilities, and he brought up a good point. I never thought about this way, is what I should say. He said that they will spend years developing things, just general manufacturing industrial complex. But those teams a lot of times are more like engineers and scientists where like the cost of the material and the economics aren't necessarily a part of the equation. So they could be developing that technology and then, spend 10 years on it and be like, hey, look what we did. And then, it turns out, well, there's not enough of this material in the world to actually make this happen. That's not the case for sodium, but stuff like that. So it also could have just been basically a project, and then they're like, well, we're gonna go forward with it because the economics aren't that bad. So one of those two probably.
Yeah, I mean, I can't tell what came first, the chicken or the egg here, but it seems like the resource constraint in nickel and cobalt forced this hard pivot towards
Yeah.
But I don't, I don't know the truth there, or whether or not it was just a price competition in terms of the EV market. But yeah,
yeah, I think LFP in that regard for sure. Was it the technological breakthrough of the BYD Blade battery that really made it take off? Yeah, but they would have had to been developing that for years, I guess. So it's probably what Rogan's talking about, where it's okay, well, especially cobalt. How do we build something without cobalt? That's more so than nickel, I believe. But yeah.
Bentley, what do you make of the role of SPOD and the balance of various sources of lithium? Say if we look forward like 10 years or something, what sort of size of the market is that going to make up?
Yeah, hot topic. I guess without beating the dead horse of DLE, I'll kind of push that to the side a bit. The interesting aspect of DLE, I'll say, we have the opportunity to sit in front of a lot of these guys that are trying to get DLE production online. And it's actually not a new technology. It's another common misconception, but the cost of it is much higher than I thought. So even where we're at now, a lot of these DLE projects won't be profitable. They might say that they are, but you got to be in the industry a while, right? If someone's, their pre-fees, are you going to take their, they're saying their all-in sustaining cost is $8,000 a ton. Okay, it's going to be higher than that. I've seen a few of those, I should say. And we know, what Arcadium/Rio is doing down in South America, for example. I think that's a little bit different, right? Where if you looked at their pilot stuff, you're like, that's not even close to profitable. I think, scaling that up and learning from that eventually those costs will come down. But brushing that part of the DLE aside, I don't think it's going to kill hard rock either. A lot of the converters and refiners for battery grade are set up around hard rock, and the economics of that part of the intermediate steps is usually better using hard rock versus carbonate. Not all the time. So that's not going away. But the interesting aspect I think that we're seeing is the possible push towards something like LSM, which is lithium sulfate monohydrate. That is a value-added step. So when you have spodumene, there's basically effectively two stages, right, before you get to a carbonate or hydroxide. And that first stage produces the lithium sulfate monohydrate, LSM, lithium sulfate. And we've seen spod producers consider putting that in on site instead of going to spodumene concentrate. Then they do that and then export the lithium sulfate, especially in places like Zimbabwe, where you have transportation costs of like $150, $200 a ton, right? If your production costs outside of that are $400 a ton, like that's great, that's low, but $250 a ton transportation costs, well, now all of a sudden your economics aren't great. So if you can add a little bit of value to it, then your transportation costs also come down because the amount of material that you're moving is less. So I believe Sinomines in Zimbabwe, they started to do it. I think major miners, especially in Australia, are going to consider it as well. I know Pilbara was working on Oh, they're working on something else, but
Midstream
I
product
think
analyst.
that's
Yeah.
where the industry.
Yeah.
Yeah, exactly. I think
You could
that's
understand the
where
rationale
things
for
will
like
go.
like a line town where their transportation costs would be pretty pretty substantial too. It's so far inland. Yeah.
Yeah, so exactly like and there will be, I think, miners that maybe still get away with spodumene if their logistics are there for it. It's kind of like iron ore, right? In that sense, but the push will be, especially for someone like Liontown, I think we'll be creating some sort of midstream product that, I mean, even if you just double the value of it, that creates a much different economic situation for where you can export from the mine. And I think that's where the industry is heading for that.
That makes a lot of sense. Makes a lot of sense. Got to ask you, Bentley, tin, tantalum, niobium.
Hmm.
Three commodities
So
close
I
to my
want to hit
heart.
on the last two. Yeah. Have you guys ever talked about tantalum or niobium?
We've certainly
I
talked
can't
about
remember.
niobium. Yeah, JD and I are shareholders in WA1 here. Ding ding ding. And then tin, of course, talk about it very frequently. Tantalum,
Yeah.
not very often. Like yeah, I mean, to the extent that there's the history of GAMs, like tantalum circuits around the old Sons of Gwalia assets in Western Australia. But other than that, very 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 little.
Wow, green bushes. That's
Yeah, yeah, yeah. There's still
uh,
a phenomenal tantalum circuit there, right? That is still owned by GAM, if I'm not mistaken.
it is.
Yeah.
It is. Yeah. I mean, it was so I sometimes read some old stuff just for, I don't know, to see what things were like. And this like base metals handbook used to be a big thing. That was from like early 2000s, and it brings up like the big tin mines and stuff, and it brings up green bushes. And I was reading that a couple years ago and just laughed. I was like, oh my god, I forgot about that. But uh, that's why they go together. I guess that's the topic though. So I think, look, niobium markets are 80+% of niobium comes out of Brazil from CBMM. Just a little bit different in that regard. It's heavily controlled by that. And then like another 10% are coming out of Canada. But tantalum, that's a pretty small niche metal that's found a lot. And I'm not a geologist, but the reason why we're involved in it is it's found a lot with the tin and artisanal stuff and throughout Africa. But it's also found in pegmatites, right? So as we were just talking about spodumene, so actually these lithium miners, if people forget, they actually do make money and sell tantalum, but it's a capacitor metal. So that's where its uses for super alloys, so aerospace, but also capacitors for chip manufacturing. So it's a pretty important metal. And outside of the lithium miners, no one, and they produce a very small amount of it, by the way. But outside of that, it's effectively all artisanal, and a lot of it came or comes from Eastern DRC and Rwanda. So there have been pretty substantial supply disruptions, and you haven't necessarily seen prices up. Don't get me wrong, 15-20%. But you haven't quite seen that follow through, and a lot of it is just like long-term contracts. There's no way to hedge it, so you do have to have different pricing mechanisms where there'll be a lag with that. But overall, the past couple of years, prices up quite a bit because demand has been up as the kind of the chip boom here the past couple of years has taken off, and now you have almost like a war, right? So wrong way to put it. Like a production war for who's going to make the next, I don't know, chip for AI or whatever. And is there overproduction there? Well, maybe Rogan knows better than me, but so you're seeing these Asian manufacturers, especially here in China, try to compete with Nvidia and stuff, and they'll get there, but it's creating demand imbalance in a metal that basically no major miner goes out and tries to mine. That's always been my long-term theory, by the way, on tin as well. Is like it's the same sort of thing, right? It's such a small amount of every electronic that no one cares if the price quadruples. Like, the electronics makers can sell a small amount, but tantalum's a similar story, and it's even less so because it's even smaller. So the supply side doesn't really react outside of artisanal. So
When you say the Rwanda Eastern DRC, we're talking about like the coltan deposits, right? Or coltan artisanal mining, and that's wow. The Rwandan percentage might actually just be the Eastern DRC kind of deposits, which are somewhat kind of just appropriate, like called Rwanda because of the you know, whoever has control of that area.
I'm not gonna get myself in trouble. So sure. There's you got to be really careful with some of that stuff if you're dealing it, because you don't know what it. Yes, what you're saying is it's
Right.
Coltan,
Right.
columnite, tantalite, it's coltan. So that's you can't the refining process of it. You can't separate it like the concentration or simple levels. Hundreds of $1 million equipment to do that. But yeah, that's where that fuel comes from. There's some out of Nigeria as well and other parts of Africa, but the disruption area is
Yeah.
Rwanda, Eastern DRC.
And is it really kind of the demand story that gets, and I suppose supply concentration that makes that kind of niche sector particularly attractive as a commodity trader? Or is it the volatility,
Yeah,
disruption?
it does. Yes and no. I mean, demand has been not as upward as you would imagine for something like that. Even tin's the same way. For someone like us, it's more of it's all smaller and artisanal, right?
Yeah.
So it's that's where our attractiveness comes in, without like blatantly saying like it's easier for us to make money, but it's actually easier for us to get in the industry, and it's easier for us to get involved in the mining part of it, the upstream part. So putting money into projects and things, they're not asking for 50, 100 million plus, right? It's a lot smaller stuff.
Small
So
capex startup. Yeah.
why we like to get involved in it. Yeah. Yep.
What about the disruption with Bissy, the major mine in the area, Bentley, coming offline for, about a month or so, because that really kicked up some of the prices that we see, and the one listed player over here, other than Alphamin being the owner. What are the ramifications and the consequences of all that action?
Well, I was sitting around my phone waiting for a call from somebody from Gerald Group, seeing if I had some supply to replace, but I never got it. They have 100% of the offtake at Bissy, so it's a lot of supply to replace. Apparently they didn't have problems. They got the concentrate out and slowly ramping back up. But I can't really speak for it other than they didn't call. I was kind of hoping, give them a really high price. No, kind of jokes aside from that. I forgot the question.
What are the consequences, and what do you think with this sort of disruption in mind? And you can maybe speak to all the other things happening in the tin market, Myanmar and the like, going forward for tin.
Yeah. So concentrate market's tight. That's not really shocking, but it was actually pretty tight without these disruptions. Remember, Myanmar and the Wall State, they shut things down. It's 2023, so it's been nearly 2 years now. And I would say the biggest surprise actually has been how long it's taken to really hurt the market. But it's there's smelters here in China that were going through their tailings, which you don't hear much about tailings at tin smelters or smelters in general to be used as feedstock. Well, you have operating rates at the smelters are pretty low. So refined tin output's gonna come down. It goes back though a little bit to the demand story that we were talking about, with kind of pulling things forward. We saw that late last year as well. Same sort of concept where tin demand was pulled forward a little bit. So that's why, outside of the spike from the Bissy news, you haven't seen tin do a whole lot other than 30,000. Is the demand's just pretty dead at the moment. How long is it going to take to go through inventories that have been built up over the past year or so? Tough to say, but that's what's happening. That's why you're not seeing too much from the final product come through yet in price outside of that short-term spike. But look, Bissy's not producing yet what they were before the disruption, and Myanmar, Wall State. Yeah, I think we talked about it over WhatsApp a couple months ago. It's been, things are coming back online in 3 months for the past year. So that's the best way I can state that.
Rogan, I know you've thought a fair bit about the tin supply chain.
Well, yeah, Well, from earlier, I remember you guys talking about where mines are and where minerals come from. I was living in Sierra Leone outside of the mine annexed by the South African mercenaries after the war, and you just start to realize that it's really challenging to use these resources as a way of development, because once you raise taxes high enough, people just start moving them across borders. But in terms of the tin market, I mean, both of these countries are tremendously important suppliers to China. It was interesting to me to see the Americans get involved in the conflict, and that certainly was something that surprised me. I think most of the minerals that the U.S. is targeting are in the south of the country, and with that railway through Zambia, through the corridor there, and then so it coming to a quick end is certainly positive in terms of stability for not only the tin market but the people of the region. I'm sure Goma and the other regions are still it's a challenging situation. But yeah, where these minerals come from and how they get to their final destination, and China being an important market for them, it's just as Bentley states, it's a tight concentrate market, downstream demand. It'll be interesting to watch over the next 6 months. But I think that what happens is that the constraint hits and then everybody panics. And so when inventories hit these historically low levels, then I think people start to pay attention, and so that's what I would watch in terms of a market reaction.
Were you surprised, being in Washington there, the Americans getting involved, and do you put any weight in this quote unquote minerals deal that's going to emerge?
In the DRC.
Yes.
Or the Ukraine one, or
Take your pick.
I would view it positively, to see more activity in the southern part of the country to develop those resources, whether it's on the DRC side or the Zambia side. I think that there is a show of commitment from the U.S. and a growing understanding that these regions are places that they must engage with, rather than a choice of engagement. And from someone who has spent a good amount of time in Africa, I view it positively. But yeah, I don't what are the teeth to it? That's a much harder thing. There's a lot of things that come out of Washington in terms of statements. We're gonna invest in the mining companies now, and from my perspective, the U.S. Would be the most successful if they developed something like a Japanese trading house than trying to get individual mining companies to pull the trigger and invest more in the southern part of the country. The eastern region is something I'm less familiar with, other than watching the media reports and trying to track where the M23 rebels are occupying. So yeah, I mean, all in all, it's extremely positive to see the U.S. engage in something that I thought could have escalated quickly, and for the betterment of the local population. I think that a retreat, or however it's going to be called, is positive.
Bentley, imbalance in the copper market. What's going on?
Well, Rogan might actually have a little more hand on the pulse here than I do. That talk about a lot with him, actually. But the imbalance really has been the flows out of regional flows. So replacing, if you're going to put a 25% tariff on something, what you could effectively do today, or have done, is buy copper at one price, sell it forward in the US, and even if that takes a year for that 25% to come in, that's pretty nice little payday, right? So it's a combination of that, and doesn't quite work that simply, but it's a combination of that and the fear of needing the copper to be there, right? If you're actually someone that distributes and supplies material or need it. And that has just caused mass amounts of flows, right? Whereas I know last year when I came on, I was like, all right, well, there's no material in North America. No one really kind of used what's there gets used. And created like the CME problems last year, whereas it's a different situation. But then this year now, it's tariffs and it's driving flows there, and it creates it's a fake demand essentially, right? It's not being transformed or value added at that point. So that it's not necessarily a fake demand in terms of price, because price can move up from it, but it's something to be wary of. Where if there's a lot of material that can come flood the market at that point. Now, I think Rogan, you were talking about why producers in South America importing material, like ramping up production just to import in the US, make more money rather than dealing with TCRCs and the like. And I know you're speaking also with somebody about recycling too in the States. Curious on if you've seen differences in the recycled markets.
Yeah, no. So, I mean, starting with the recycling side, and I've been pounding my head on the table about these tariffs, because it seems like they're risking millions of jobs in construction for 130 jobs in a smelter. But in the US, the bottleneck is the mine, or in this case, the scrap as an input, and the rest of the world, it's the smelter. There's too much capacity. But the US exports 1 million metric tons every year in scrap, and scrap dealers make a profit off an arbitrage, right? So, they buy from a manufacturer, whether it's Bear Bright or number 2, and they try and sell it for more than they bought it for. It's a pretty simple business in that regard. But the fact that your capacity in the United States to process this material is less than what you're producing means you have to export it. And now the LME is a 15% lower than the COMEX. It means that a scrap dealer is either building additional inventories or selling out into the global market. So if you take a 12-month rolling year over year, U.S. exports of copper scrap, traditionally, as copper prices rise, scrap exports increase. It helps to rebalance the market. But that mechanism is slightly broken, because a scrap dealer now needs to wait till that position goes up 15% more to actually make a profit. So they're either selling at a loss into the global markets, if there was no price volatility, or they're waiting for prices to rise in order to sell. So whether it's the manufacturers that are holding inventories of scrap, whether it's AT&T figuring out that they've got a couple thousand tons in their warehouses that they can get rid of, when prices rise, people start looking at scrap and start offloading it. And those scrap dealers are in a challenging position, because there are fewer and fewer arbitrages. On the other side of the Pacific, though, what's really interesting to me over the last month or so of data is that China's exports of refined copper are increasing with the Yangshan premium and the market in backwardation.
Yeah.
And so those issues, if we look at the decline in inventories, I think we're down over 60% in the last month. And in the US, you're up over 50%. And so how are price mechanisms operating? Well, if I'm trying to sell right now, I'm going to the Americans and I'm saying, listen, if it gets to port, I'll take it back if the tariffs are implemented. Don't need to worry about it. We'll just cancel the contract there. But if it gets to port, you're getting a great deal, because I'm selling it to you below COMEX. I can link to the LME and my business is fine. And so there's this rush to deliver into the United States. And that creates a predicament for the Asian markets, and in particular China, which consumes more than half of the world's copper. And unlike last year, when we saw a peak demand destruction associated with real estate on a 12-month rolling basis, or that's how I put it through, and that's what the data showed. There's less demand destruction associated with real estate right now. Everybody's rushing to get these renewables installed. And the question is whether or not we have a drop off in demand in the second half of the year from China and in the renewable sector, whether battery production expansions can make up for that, whether the grid investment that's extremely robust right now is consuming more copper, or they're switching to aluminum on these ultra high voltage lines. So there's tremendous, the demand question is totally uncertain. But one thing is for certain is that the marginal production of refined cathode and rod is being delivered into the United States for profitability reasons. And China's finding themselves in a quickly declining inventories, rising prices, and the market, if I'm, can say what I hear is that the Chinese start rejecting prices at 80,000 RMB per ton. So that's the level to watch as inventories decline into June, and whether or not you see the Chinese buying at above 80,000 RMB per ton is kind of what I'm looking for. But in the short term, it's really hard because a trader takes a risk by delivering to the U.S. In terms of when the Section 232s come out, and they're saying they should come in Trump time. So if that means in short order, it means it could come any day rather than the allotted period for Section 232 to go into through the investigation. But yeah, if it's in line with some of the other dramatic moves in terms of metals tariffs, the market is right to price in this premium right now. But the contango in the U.S. and the backwardation in China kind of just is a great depiction of where the flows are going and the issue to develop in the coming months.
How does this play out?
Oh, geez. Well, I guess there's multiple paths, right? So if COMEX, the response from COMEX on the day of the Section 232, whether it is or isn't implemented, will be very interesting, right? Because if it isn't implemented, it should fall back to the LME price, at which point everybody would want to buy off of COMEX and sell into China. But I have a hard time thinking through what happens with the Section 232. I have an easier time thinking through Chinese inventories continue to decline on a week basis. You get them on Friday morning. And when they hit this level, of, let's say, 20,000 metric tons of available unwarranted inventories, do we see backwardation continue to increase relative to other futures prices, forward futures? Because then everybody's trying to lock in these inventories. I always like to come back to the key in this industry is always wire and cable. So raw and production rates, and then the wire and cable operating rates are my key indicators of downstream demand. Thin films, sheets, all of these other materials and copper markets are important. But if the wire and cable is humming, then we could see higher prices.
Enlightening, Rogan. And maybe for us to wrap up, any last thoughts on the tariff mess that we're seeing daily?
I think about this more often than I should. There are communities in the United States that have been decimated by globalization, but I believe that the production frontier is optimized with free trade. Disruptions to free trade are detrimental to growth and ultimately are paid by the consumer as in a form of a tax. So efforts by the Trump administration to reshore supply chains and remake the American economy will likely not succeed in the short term. And the amount of economic pain associated with the disruptions, I think, are keys to why we ended up where we were today. I don't know if this will go out today, but yeah, today was essentially Liberation Day +7 for the rest of the world. We're right back to where we started before Liberation Day, and a lot of it is that you'd end up with empty shelves in a month. So the soft data turns to hard data, and the hard data then eventually shocks the consumer, and that's something I don't think I would want to have my name on as a president. So I think there are extreme challenges associated with the imbalanced trade relationship with China, but I don't necessarily believe tariffs will solve it.
Bentley,
do you think it's I was gonna ask Rogan, do you think it's I guess too late to solve or to prevent any of the not any economic damage, but let's say notable economic damage?
I'm of the opinion that a 10% rate on the rest of the world, whether it's bananas or what have you. It increases prices, which will increase inflation. That can be a one-time shock in prices, but it'll raise the rate of measured inflation. And at that point, it makes it harder for the Fed to lower rates. If the tax bill this month comes out and they blow out, the budget, it's just one more reason that, you could see, demand outstrip supply and prices just rising higher. And I think that's a really awkward position for the bond market as well. So the tariff situation, a lot of it's baked in at this point. To answer your question directly, it could be made worse by other policy decisions. I'm not bullish on the U.S. economy in the short term because of this price shock. But I think we have some of the most brilliant and excellent tech engineers, and some of the things I'm seeing in AI make me optimistic about the future. So, I'm sorry, that's a little bit rambly, but yeah.
Well, I was going to ask, because I know you're a FIC guy too. So like, just in general on the dollar, I mean, it's come back and rates are, I don't know, I would call low across the curve. So are you, I don't know, especially with some of you guys' clients, are you guys seeing people, I guess, unwind that dollar short and short yield or long yields play? Or are they still thinking that that's coming through? Because in reality, like, tariffs not less than they were going to be, but that deficit is not getting solved, and it's not like stuff still happens. It's still a problem.
Yeah, I mean, it's the looking at capital flows is like looking through a bowl of spaghetti noodles. You never know where along the path this flow comes from. But I believe that the East Asian savers have certainly pulled back, the insurance companies, and I also think that European repatriations have happened. I think if I was investing in the environment right now in the United States, I think on the fringes of the market, places like private equity, venture capital, I don't want to send money to the U.S. and lock it up for 7 years at this point, because of the regulatory landscape is becoming a little less foreseeable in that time range. And so, you can see fast money flows back into to debt securities in the U.S. for sure. But I think some of these more private markets will have a little bit more of the challenge going forward, attracting foreign investors.
Oh, interesting. So I guess, I can't remember how much you really see, or talk to people in the private markets, but there was, especially in real estate, right? There's been so much rollover in that space. How's like, if outside money doesn't come in to make the next, to extend funds, or we're going to have series 7 of our fund or whatever. Yeah. I feel like that's kind of that becomes a problem, especially we won't get into a pension discussion. That's Rogan and I's previous life, but like, does that become almost like a tipping point of I don't want to say a financial crisis, but something more significant that we've seen?
I think that the issue remains that the United States is the global reserve currency. These individual markets will rebalance in a way that identify market clearing prices, but the attractiveness of the U.S. and it appears in an intentional decay of attractiveness to investing in the U.S., whether it's greater control over private markets, intentions of bringing back supply chains that have higher costs. It's not the post-2008 capital market that everybody flooded money into. And it seems that some of the pushing of money away from the U.S. is intentional. And so I don't know how that's the balance I think about more. I can't tell you how the market clearing prices of real estate and the private transactions associated with it will will find its place. But yeah, I mean, some more liquid fund comes in and buys out some private fund, and someone takes a loss along the way. But yeah, the main story and the question we should all have is, where does the marginal dollar of investment go to? And if and hopefully a lot of the rest of the world could use investment, and a lot of, in my belief, the largest shortage of metals is based in the copper market. And we have climate change, but also competition coming from some of these renewable sectors. And so it'll be very interesting to watch. And then, there's this theory that there's a dual economy. Who can produce the most energy will produce the future. And so artificial intelligence is going to be limited by the amount of energy you can produce. And so again, I always come back to copper as the indispensable metal.
It's a great place to leave it. I've loved the dynamic that both of you have brought to the episode today, and just it was wicked to kind of sit back and hear the both of you kind of ask each other questions. I'm gonna have to listen back to that one, JD, myself, even though I was part of the conversation. This has just been awesome, Bentley and Rogan. Thank you both so much for joining us.
Thanks, guys. Appreciate it.
Thank you.
Appreciate it. All right.
There we go, mate. And a massive thank you to all our partners. Firstly, Mineral Mining Services, Branded, Sandvik Ground Support, CRE Insurance, K-Drill, KCA Site Services, Black Diamond Drilling Services, and Cross Boundary Energy. Hoodoo Money Miners.